Have you ever wondered why your neighbor got a refinance rate so low it made you jealous, while your bank quoted you something way higher? You're not alone. Mortgage refinance rates can feel like a mysterious game where the rules are never fully explained. But what if I told you there's a way to understand exactly how these rates work, and even how to tilt them in your favor? Stick around, because by the end of this video, you'll know what the banks don't want you to figure out. Number 1. What is a mortgage refinance, really? Let's keep it simple. Refinancing your mortgage means replacing your existing home loan with a brand new one, usually with better terms. Think of it like trading in your old car for a newer model. Same house, but now with a loan that could save you money on interest or lower your monthly payment. For example, if you took out a loan at 6% a few years ago and now rates are around 5%, refinancing could save you thousands over the life of your loan. But here's the twist. The rate you see advertised isn't always the rate you'll get. Why? Let's find out. Number 2. The biggest factor, credit score. Your credit score is like your financial report card, and lenders look at it very closely. The higher your score, the less risky you appear, and the lower the rate they'll offer you. For example, someone with a score of 780 might be quoted 5%, while someone at 640 could get 6.5% for the same refinance. That's a big difference over 30 years. If your score has improved since you bought your house, refinancing could help you snag a much better rate. And if your score is still low, it might make sense to wait and work on it before applying. Number 3. The loan-to-value ratio matters more than you think. This is just a fancy way of saying how much you owe on your house compared to what it's worth. Let's say your home is worth $300,000 and you still owe $240,000. That's 80% loan-to-value. Most lenders love to see you at 80% or lower. If you're over that, they might tack on extra fees or even deny you a good rate. So, if your home has increased in value, or you've paid down a chunk of your mortgage, that could work in your favor when you refinance. Number 4. Why your income and debt still count. Even though you already have a mortgage, lenders still check your current income and debts when you refinance. They want to see that you're still able to comfortably handle the payment. For example, if you've taken on a big car loan and some credit card debt since you bought the house, they might see you as a bigger risk and give you a higher rate. On the flip side, if you've paid off some debt or gotten a raise, that could help you get a better deal. Number 5. Timing can make or break your rate. This is where things get really interesting and frustrating. Mortgage rates change daily, sometimes even a few times a day. Why? Because rates are influenced by things like inflation, the Federal Reserve, and the overall economy. Here's an example. If the Fed cuts interest rates to stimulate the economy, mortgage refinance rates usually drop. But if inflation is rising fast, lenders tend to raise rates to protect their profits. So timing your refinance during a low-rate window could save you thousands. But no one has a crystal ball, so it pays to watch trends closely. Number 6. The type of refinance you choose. Not all refinance loans are created equal. For example, a cash-out refinance, where you borrow more than you owe and take the difference in cash, usually comes with a higher rate than a standard refinance. On the other hand, a rate-in-term refinance, where you simply lower your interest rate or shorten your term, usually gets the best rates. So be clear about your goal. If your main priority is saving money over time, a cash-out might not be your best bet. Number 7. Fees and points. The hidden catch. Here's where many people get tripped up. Even if the rate looks great, refinancing isn't free. Lenders charge closing costs, often equal to 2% to 6% of the loan amount. On a $250,000 loan, that could mean paying up to $15,000 upfront. And then there are points. You can pay discount points to lower your rate. Each point costs about 1% of the loan amount and usually reduces your rate by about 0.25%. So if you plan to stay in the house for a long time, paying points can save you more in the long run. But if you're moving in a couple of years, it might not be worth it. Number 8. Fixed versus adjustable. Which works for you? When you refinance, you can choose between a fixed-rate mortgage and an adjustable-rate mortgage, ARM. Fixed rates stay the same for the life of the loan. No surprises. ARMs usually start with a lower rate than fixed, but that rate can rise over time. For example, a 5/1 ARM might offer 4.5% for the first 5 years, then adjust annually. If you plan to move or refinance again before the adjustment kicks in, an ARM might save you money. But if you're staying long-term, fixed might be safer. Number 9. Why shopping around is your secret weapon. This one surprises a lot of people. Different lenders can offer wildly different rates, even on the same day for the same borrower. Why? Because each lender has its own business strategy, risk appetite, and overhead. For example, Bank A might offer you 5.2%, but Bank B could give you 4.9% with the same credit and income. That's why experts recommend getting at least 3 quotes before choosing a lender. Even a small difference, like 0.5%, can save you tens of thousands over the life of your loan. Number 10. How to know if refinancing is really worth it. Here's the million-dollar question. Should you even refinance? A good rule of thumb is if you can lower your rate by at least 1% and you plan to stay in the house long enough to break even on the closing costs, it's worth it. For example, if refinancing costs you $6,000 but saves you $200 a month, you'll break even in 30 months. If you're moving before that, it might not make sense. Some lenders offer online calculators to help you figure this out, where you can simply divide the total cost by your monthly savings. Number 11. How your loan term changes your rate. The length of your new loan, called the term, also affects your refinance rate. Shorter terms like 15 years usually have lower rates than longer terms like 30 years. For example, you might see a 15-year fixed loan at 4.5% while the 30-year fixed is at 5%. Shorter terms mean higher monthly payments, but you pay less interest overall and save more in the long run. If you can afford the higher payment, choosing a shorter term can be a smart move. Number 12. Your property type makes a difference. Not all homes qualify for the same rates. If you're refinancing a single-family home you live in, you'll usually get the best rate. But if it's a second home or an investment property, lenders see more risk and charge higher rates. For example, refinancing your vacation cabin might cost you 0.5% more than your primary residence. So make sure you understand how your property type plays into your quote. Number 13. The impact of mortgage insurance. If you have less than 20% equity in your home when you refinance, lenders may require you to pay private mortgage insurance, also called PMI. PMI protects the lender, not you, but it raises your monthly payment and effectively increases your rate. For example, if your home is worth $250,000 and you owe $230,000, that's more than 90% loan-to-value, and PMI would likely apply. Paying down your loan or waiting until your home value rises can help you avoid this extra cost. Number 14. Why locking your rate is critical. Mortgage rates can change fast, even in a single day. That's why lenders give you the option to lock your rate while your refinance is being processed. A lock guarantees your rate for a set period, usually 30 to 60 days, even if rates go up. For example, if you lock at 4.8% and rates rise to 5.2% the next week, you still get the 4.8%. Just remember, if rates drop after you lock, you won't benefit unless your lender offers a float-down option. Number 15. The role of your lender's fees and service. Not all lenders are equal when it comes to service and fees. Some might offer a lower rate but charge high junk fees like processing, underwriting, and document prep. Others might offer a slightly higher rate, but with no hidden fees and better customer service. For example, one lender could quote you 4.9% with $5,000 in fees, while another might offer 5% with $2,000 in fees, which could save you money overall. Always ask for a loan estimate form from each lender so you can compare apples to apples. You see now that mortgage refinance rates aren't some random number your bank pulls out of a hat. They're a careful calculation based on your credit, your home, your finances, and even the economy. And here's the part one promised you earlier. A little-known secret most people overlook. Many lenders are open to negotiation, especially if you come prepared with competing offers. That's right. If you show them you've been shopping around, they might just lower their rate to keep your business. So don't be afraid to ask. Now that you know how mortgage refinance rates really work, what's the one thing about refinancing that still confuses you? Let me know in the comments below. I'd love to hear your thoughts.